FOMC minutes, shorts are getting deleted, and 475% cost to borrow max. What do all of those have in common with the sleepy meatball? Well, all of them want you to slap that like as you guys come in, because that's the best way to be able to get this video out to as many retail investors as possible. Notice how the short interest has now been declining to the lowest point that we have seen since July 2021. But guess what else happened in July of 2021? The prices skyrocketed. So that's why I want you guys to be able to follow along with these minutes. These are going to start with the central tendencies, ranges, and economic projections. Just kidding. I'm going to explain all of this in simple languages. So if you guys wouldn't mind, watch until the end of the video. Comment out which like you guys are the way up to 1300, and let's get going. Change in real GDP over the past 5 years, all the way up to projections for the next 4 years. 2022, this is a box and whisker plot. Essentially, the price is the actual change in GDP is probably going to be around this area, and the 2023 estimation and the 2024 estimation as well. For some reason, it gets even easier to estimate in the long run. The reason why this is important is because it gives us the better understanding of where unemployment is, essentially relatively flat, and finally PCE inflation, which has spiked in 2021 and has a similar estimation in 2022. This brings us to the FOMC minutes directly. After the release of higher than expected inflation data, policy sensitive rates, let me just highlight this. I love to highlight. After the release of higher than expected inflation data, right? Policy sensitive rates pointed instead to a considerable probability of 75 basis points moving both the June and July meetings. This market implied path of the federal funds rate moved higher at longer horizons as well. Market as participants noted elevated uncertainty about the economic monetary policy outlook. Yeah, that makes sense. This was a big upset. We covered this in the last few videos. Go ahead and check them out if you haven't already. But this correlates with exactly what we see in terms of inflation. That's why inflation is so important to be able to match with GDP. Because if enough people have enough credit to continue working at their day jobs, and yet at the same time holding those dime in hands, this gives the retail investors, especially the people, the millions of which are holding the stocks you guys care about, a more incentive to be able to hold past a potential short deletion. And that's what we're going to cover later on in this video. Exactly what was that 400+% cost to borrow max, and exactly why did the shorts start dumping. All told, total PCE price inflation was expected to be about 5% in 2022, while core inflation was expected to be about 4.1%. We saw that in these projections here. And PCE inflation. However, PCE price inflation was then expected to step down to 2.5% in 2023 and 2% in 2024 as energy prices were forecast to decline and supply-demand imbalances were projected to diminish because of slowing aggregate demand and an easing of supply constraints. Similarly, core inflation was projected to slow at 2.5% in 2023 and 2.5% in 2024, right? 2.6 and 2.2 respectively. This is important because we have now upcoming wars, and this is exactly from Jerome Powell's voice. He is the one pointing this out here. The staff continued to judge that the risks to the baseline projection for real activity were skewed to the downside, and that the risks to inflation projection were skewed to the upside. The staff judged that the ongoing war in Ukraine remained a possible source of even greater upward pressure on energy and commodity prices, while the war and adverse developments associated with China's zero COVID policy were both perceived as an increasing the risk that supply chain disruptions and production constraints would be further exacerbated in the United States and abroad. Honestly, when the real estate bubble crashed in China earlier the past few months, you should have already expected that a lot of that country's infrastructure, in terms of the investments that people were legally allowed to do, were tied in very, very small baskets, and all of the eggs are piling on top of them. So essentially what you do is consider the global economy when you do any sort of investing, especially large players like the potential wars coming up and potential trade disagreements. Those are all bad things that could end up hurting the recession that the FOMC is seemingly implying that we're going through. Okay, getting close to the Ortex data here. Or across the yield curve, rates on nominal treasury securities ended the period significantly higher, primarily reflecting the revision on the outlook for monetary policy and the associated rise in real yields. Market-based measures of inflation compensation continued to indicate expectations that inflation would decline notably in the coming quarters. But notice how there is compensation and GDP increasing. So this all ties back down to exactly what do the retail investors, the people like you and me, have in order to be able to send back in terms of dry powder. This is why we want to be able to pay attention to that orange line here. So I'm going to highlight this in yellow. So this orange line is short interest. In fact, this is measurable short interest across ORTEX. So it spikes up in January 2021. You guys remember what happens after that. It goes all the way back down at its lowest point in July 2021. I'm going to now highlight the prices. The prices are going like this. They spike. They go back down. Sorry. These are the prices down here. They spike in 2021, they go back down, and then they have an enormous resurgence in July 2021, exactly inverse of those shorts being able to not sustain those shorts anymore. They fold their short positions, and at the exact same time, the price action goes skyrocketing. So that is exactly why we are now, let's go back down to the year to date, we are looking at shorts going down to about 14%. So right now we have borrowed shares here about 13.78 million, borrowed change about minus 3 million. So that means that we have a lot of shorts getting deleted across the potential space that ORTEX can even scrape, right? So short interest right now is holding at a whopping change of down 24%. So that it gives us the exact same conditions that we saw in July of 2021. And the best part of it is that this is a lot similar to why we are now seeing the FOMC report indicate that there is credit running out for a lot of these larger organizations, but GDP and compensation rising for the retail investors. So that's a good combination, and the same combination that we had in January and in July of 2021. So that's why we are now looking at everything in context, being able to sort through all of this messy data, as well as the fact that we now have a better understanding of where that 475% came from. If you guys are unfamiliar, I'm going to pull it up real quick. You guys probably had seen that even ORTEX had tweeted about this. Yes, AMC CTB max appears to have spiked from 25% to 475%. A few things to remember though. A stock loan for one share can theoretically set CTB max min, which is why CTB average is also very important. But the point of the matter is, cost to borrow is about willingness and about setting an agreement. So if somebody's slapping the 475%, then gets their rate accepted, that means that somebody's desperate, and that means that a lot of the shorts that we could have scraped across ORTEX is now getting deleted across those scrapers. So where are the shorts hiding? Well, I'll be covering that in excruciating detail, so if you guys wouldn't mind slapping that subscribe button and that join button, because Professor Meatball is waiting for you to join the Moon Platoon. It's really easy, and it costs less than a coffee. You get access to a 6-figure portfolio, you get access to this diverse group of people on Discord and on Patreon, and we'll see all of you in the money. Peace.